introduce your name, the company you work for, and the particular yield-bearing coin that we'll be talking about today.
Awesome to see so many familiar faces today. I'm Jelena. I'm the co-founder CEO of Noble. Noble is stablecoin issuance chain or platform. Most recently, we launched Noble Dollar USDN in partnership with M0. USDN is a yield-bearing stablecoin pegged to the US dollar over collateralized by treasury bills. We could talk about the model. Yeah, thanks for having me.
Great. Thank you for having me here. My name is Carmi. I work at Figure. I run the exchange, the ATS, the broker-dealer, and we just launched a product called Yields, YLDS. It's the first SEC-regulated certificate-based security that operates like a prime money market fund and a stable coin. It's the only security in the financial services that allows peer-to-peer transferables. So you can use it as a stable coin, or you can use a money market fund, or both, whichever one you want. We'll talk more about it through our conversation too.
And thank you. I'm Armand Khatri. I'm head of ecosystem over at Ondo. Ondo has two Yieldcoins, one for more US-centric audiences, which is OUSG, and then we have a permissionless Yieldcoin that is globally accessible, non-US, and that's USDY.
Awesome. So let's start with just some basics. At BVNK, we see a lot of treasury management, cash movement as we move stable coins cross-border. We do a lot of volume in Tether and USDC, but these stable coins don't have like an inherent yield component to them. Tell us just in brief words, what is the problem? Give us an overview of your token, your coin. Like, what is the problem that you're solving that USDC or Tether does not?
Yeah, for us, working with M0, they created a very elegant solution to this where, similar to USDC, you have this dollar-pegged stablecoin collateralized by treasury bills. These are short-term T-bills, on average around 60 days of maturity. So it's a highly liquid, highly safe asset. But of course, that yield component that typically gets passed on to either in a B2B fashion, like Circle with Coinbase, or is all retained by the company, we can actually share that with application builders. We can share that with DeFi protocols. We can also, in certain cases, share that with end users. So again, very safe, very crypto native, very programmable. But again, that yield component is something that's a lot more distributed than what you see with the Circle or Tether.
I mean, our product, again, it's a security, so we're legally allowed and obligated to pay interest back to our clients. There is an S1 that was published, SEC regulated and approved. You get SOFR minus 50. It's invested in short-dated treasuries, overnight repo, and some money market funds that invest in short-rate treasuries. We can invest in any fixed income security if we want to. And again, as I indicated earlier, the beauty of the certificate, it's peer-to-peer transferable. And we are obligated. It will always be pegged to the dollar one-to-one. It can unpeg, well, otherwise we'll be in trouble with the SEC. So you don't have to trust that we're doing what we're supposed to be doing, because we're obligated to do what we're supposed to do with it as a U.S. security.
Yeah, so again, like two products on our side. I think to answer your question, the big difference, obviously, yield. That's what we're talking about, right? So 150 billion in stablecoins outstanding in like a roughly 4% T-bill environment. That's 6 billion left on the table of people who are holding like USDC, USDT, and they don't have any investor protections either. They just essentially have unsecured notes. We're offering products that are regulated. I believe all of us have a regulated product that is actually offering investor protections, which you don't typically see on chain, while also giving yield. So it's a sort of win-win scenario. And so the question is, what's the trade-off? And I think the trade-offs, at least how we see them on our side, are which products actually have DeFi interop, and our USDY permissionless coin has DeFi interop with over 100 different protocols on 12 different chains. And then the other trade-off is instant liquidity. You know that if you're holding a stable, you could on-ramp, off-ramp pretty quickly because there's a large amount of it, 150 billion, that's sitting there on chain for you. So our OUSG product, which is geared towards US qualified purchasers, has that instant liquidity facility up to $60 million in a day.
Yeah, that's a good point. The yield is not just yield, it's client yield. It's safe and secure from a regulatory perspective. And I know that the Genius Act has been getting a lot of headlines and attention. And in many ways, you guys have been thinking about the future that comes with that, as well as you've designed these products with high net worth and institutional allocators in mind. So maybe if you guys could go a little bit deeper now on the compliance component, who are the investors here in the audience that can legally allocate to these different products? Why were they structured this way? And what are sort of those tools that you guys have in your toolkit from a compliance perspective that allow this to happen?
Yeah, I think it's important to remember that the Genius Act is still new, and we expect it hopefully to pass actually this week and become law. Who's familiar with the Genius Act and has been studying it? Yeah, so quite a few people here. So on the yield component, there is some nuance there. So yes, for any licensed issuer in the U.S., whether you're licensed by the federal body, which will be under the OCC, or by a state, if you're over 10 billion in assets issued, it's going to be by the feds. If it's under 10 billion, it could be by one of the states. Basically, you can share yield B2B, right? So what we see with Circle and with Coinbase and what you're going to see with issuers and probably retailers and other kind of sources of distribution, that will be totally legal. But of course, passing on to the end user in a passive way won't be. There is some nuance when it comes to DeFi and when it comes to what they call peer-to-protocol transactions. So basically, if you're passing on yield in a way that is technically managed not by a person or entity or even a DAO, but by basically a smart contract, maybe even AI agents in the future, that becomes a little bit kind of gray. So there will be some, let's say, interpretation on this yield component when it comes to, again, DeFi and peer-to-protocol transactions. But for the most part, yeah, basically, we won't see this passive ability to pass on yield to end users.
Yeah, with Congress, we got to move little by little, and hopefully they don't interpret in the wrong ways.
Yeah, I mean, our product allows us to do all of the above. We don't have to do peer-to-peer with it. Anybody that holds yield YLDS can earn the full interest on it. It's accrued daily, paid monthly in kind. We can pay it in USDC or USDT or in US dollars if you wish. As far as DeFi is concerned, we are working with Prov Labs over there. Hello, Anthony, to create a wrapped yield that will allow us to have the ability to transact yield on DeFi platforms. The big component with yield right now, because it's a regulated security, there is a transfer agent. You need to be KYC and ML. We will do all of the above. And then if we want to go into DeFi, which is non-KYC, non-ML platforms, we're going to have the ability to do so under a wrapped yield product. It will give broader coverage for us. When I take a step back and I look at, you mentioned $150 million, I think. There is over $50 billion right now that's being posted between USDT and USDC as collateral. This is clients are not earning interest on it. And for some of us who've been in TradFi, the amount of collateral that exists in the market is a lot bigger than $45-50 billion. So what we've seen, a lot of interest in our product is the fact that security, it's regulated. There is trust and truth behind it. People see it. Okay, this is a regulated product. We know it can depeg. We know we can always get the money back. If you don't follow the guidelines of the SEC, you get in trouble. So there is two client segments that we're seeing interested in it. One client segment is, hey, I run treasury. I have money invested in a savings account or in a money market fund. I can put it in yield because at the end of the day, I can also transfer it. Unlike some of the other money market funds, you can't transfer it peer-to-peer, while ours you could. And then from a trading perspective, a lot of the trading firms, they like the idea of holding our product because they can hold it and earn interest on it. So from a cost perspective, it lowers their cost of capital because they're earning for yield on their collateral.
Armand, do you want to add anything on that as far as the regulated offerings? One of the things I see a lot of is this collateral and treasury management at BVNK. We've noticed a ton of our customers, they want to hold stables on their balance sheet because they have so many more options when it comes to yield. And I imagine as these, CFOs and other, payment executives that come through our doors, I think eventually they're going to start asking hey, what about your suite of products? What other yield options you guys have for us? So when it comes to your regulatory structure, are you seeing people kind of treating your tokens a lot like the on-chain mutual funds that they are? Or are they treating them more like cash-like instruments where they're hey, we're going to actually integrate this into a payment flow to actually pay liabilities for some of our customers or vendors or anything like that?
Yeah, it's an interesting question because we had to actually make some design decisions on how we structured our tokens. If you think about OUSG, which is our qualified purchaser offering, it actually holds BIDL, it holds Franklin Templeton's Benji, it holds Wisdom Tree's offering. It actually holds all these other institutional short-term treasury bills that are on chain. Really, what it's actually serving as now is this sort of smart router that's jumping between these funds should they have higher management fees or should they have a very high bar are for their minimum purchase threshold. So because it operates as this fund and because it could accumulate in value instead of actually rebasing in value, which means you're not receiving airdrops of the yield every day, it's structured in a way that is quite strategic when it comes to a tax perspective. You don't want to have those micropayments every day, and you don't want to have a taxable event every time you jump from one fund to another and actually trade tokens. But if that's all happening on the back side and you're actually just holding the same token on the front end, then it's a much cleaner experience for the end user. So I think the regulation sort of informs some of the design of these products, and that's going to continue to happen.
Yeah, I agree. Let's talk about the collateral use case that you were talking about. So Nick, you said there's about 50 billion sitting as collateral, but essentially it's not the most efficient use of that collateral because it's not earning yield, right? Could you talk about that a little bit? And then also opening it up to the panel after that, like how are you guys working to maybe integrate with, let's say, payment processors to encourage more velocity of these tokens, not just allocating, but actual velocity?
I mean, collateral is a key point here because it's basically how do you mitigate your risk and capitalize your cost of, lower your cost of funding. So if you have a transaction on, you're an exchange, you're posting $100,000 worth of Bitcoin or dollars, you're not earning a VIG on this. So that's costing you. So being able to post something like our product yields is very important. Now, again, because we feel, and we've spoken to a lot of the exchanges about posting yield as collateral, and I know they haircut some of the other products. They don't think they're going to haircut our product because it's a regulated product by the SEC. To them, they feel very comfortable that the ability for it to depeg is never going to happen. So, which is very important. So instead of depositing USDC, for example, USDT or any other stable coin, you instead of getting 100% for it, you get 96 or 97%. With our product, getting full 100% of the value of the collateral to post for it, and you're earning interest on it. So that's very powerful as well. As far as the payment rails, that market is huge, as you know. I don't know which is bigger, the collateral market or the payment rails market, but it's equally as big. It adds a lot of value when you're using a stable coin money market fund like product, where you're actually every time you're holding it, right, you're earning interest for the amount of time you're holding it, and the interest will follow you, which is what our product can do.
Yeah, just a quick note on this. It's a very hot topic in the hyperliquid community, obviously. Being able to use one of these yield-bearing stablecoins as collateral in margin trading accounts for all of the reasons you just mentioned. I think the products that will, I think, do well do have to be composable. They do have to have some element of programmability because interest rates can change as well, and maybe at any given point you can, perhaps do different things with the yield, like do a buy and burn of the token. I know that's something that exists right now in Hyperliquid, just from a protocol economics perspective. So yeah, I do think obviously collateral for trading is important, but I think there's even more interesting use cases that you could think of when programmability comes into the mix.
Yeah, we haven't even touched on that. I mean, that's the other thing that is such a major aspect of internet native money.
My concern with programmable yield is that it creates more risk. You're chasing the yield, and if you want higher yield, you're taking more risk. So a lot of the clients we've been speaking with, right, they like the idea of I'm earning a yield, and the yield is equal to SOFR around and something. But if I'm earning a yield that's equal to 8%, you're doing something different than just there's something risky about me earning anything above SOFR. So this right. Or even if you go to triple investment corporates, which you need 6-7% on them, you're taking a lot of risk there. So again, you can manage how you can generate higher yield. That's very easy to do, but you're taking more risk, and managing that risk is it's done. A lot of firms do it. I've worked on a training firm. A lot of smart people can do it. But the investors, I can tell you, at least from what we've been hearing, they're just happy with a money market-like fund product that's investing in boring treasuries, even though treasury rates have been going down. They're still very happy with that. Of course, they'd like to see higher rates, but again, higher rates, more risk.
It's funny, though, because I feel like the on-chain natives are looking at some of the yields offered by Yieldcoins, and one potential criticism of Yieldcoins where they are right now, and maybe why they don't have as much adoption, is because the yields are too low to attract an on-chain native. But I think from our side, when we think of go-to-market, we think of how could we embed yield in a way that is a sort of one-click rehypothecation without adding additional risk above that SOFR rate, where people are currently not experiencing anything. So their stables could be rehypothecated on the back end to something that's yield bearing, and if and when they need those funds, then they could actually use those funds as if they're stables.
But you're investing your products in money market funds. So you're not investing the Biddle Benji, it's all money market short-dated treasury products that you're investing in. So you're really not hypothecating the USDC because they're giving you USDC or dollars to buy into the fund. And you're allocating the money into a basket of money market funds. So it's not hypothecation because hypothecation is a little bit different when it comes to trading and borrowing and lending.
Sure. So on the USDY side, it's all short-term U.S. Treasuries that are held by a separate, a segregated LLC within Ondo.
Yeah.
And by rehypothecation, I mean within a user's custodial account, let's say, like on a BitGo or et cetera, users can actually opt in to convert those stables into USDY when they're not being used. So while they're sitting idle, they could actually be earning yield.
Yeah, but that step is actually they're giving up their USDC to you because you're taking it and you're going into the market and you're investing into it.
Jelena, I wanted you to jump in.
Yep.
Just a very quick thing to be clear, when I said programmable yield, I didn't necessarily mean like juicing that yield by through lending or making it 6, 7, 8%. What I actually meant in like a very concrete case is you can imagine a DeFi application. Think of it hyperliquid, right? That 4%, there's like what, $2-3 billion of collateral. I think maybe around $2 billion on hyperliquid. You could theoretically take that 4% and you could take 2% of that, give it off to traders, take the other 2%, do a buy and burn of the token, pretty much splitting that yield component and basically through different incentives, through different opportunities, or whether it's user acquisition, whether it's even a short-term rewards campaign, I think is like basically interesting. So when I said composable and programmatic, I didn't necessarily mean, making that something that's more risky than that base short-term rate.
Yeah, because there's the traditional framework you take to typical investing, like AAA grade or not, whether it's a junk bond or not. But then there's this whole smart contract layer as well. So briefly, could you guys tell me, like, what would you tell an allocator who's a little concerned about deploying on chain, who's familiar with those other risk ratings? And then we'll do a final question after that.
I mean, honestly, I would ask, why are they deploying on chain to begin with? Of course, like, we want the pie to grow and we want everything to, change. But hopefully the reason they're deploying on chain is to solve another problem. And I think in conversations we've had recently with whether it's like banking institutions or organizations that are non-US in particular, for them to have an easier way to access short-term T-bills and to not have a lot of the other requirements that came with it in the past, given their jurisdiction, makes it very, approachable and attractive, and that risk that they would take on of having some secure multi-sig or a qualified custodian hold on to those assets for them is very justifiable. Now, when we're getting to the interop within DeFi and taking it up a level, that's a completely different conversation for a specific allocator.
I mean, I agree with Armand 100%. I mean, it's a lot of the allocators are interested on how do I get into the space without having to buy Bitcoin and get something else that's digital. That's pretty cool. There's a lot of companies that are in digital asset space where you can see all the transactions on the blockchain, but all their investments are happening in a money market fund that's not on the blockchain. Now they can buy into some of our products and everything is on the blockchain. So you can see what the strategy is and where their investments are.
The only thing I would add to that is maybe better liquidity, 365 days. That's what blockchains enable.
Well said. And we're kind of having to wrap up this panel. And so as we go to the next panel, one thing I want you to leave the audience with is tell us maybe in 10 words or less, what are you excited about that stablecoins will enable? Don't worry, I won't count. It won't be a quiz. I won't count your words. But what will stablecoins enable that just aren't possible today, maybe even as soon as next year or into the near future?
I would say better incentive alignment between issuers and distributors. So the banks, the payments platforms, the neobanks, the retailers who want a piece of the stablecoin pie being able to earn a portion of that yield through these basically B2B arrangements with issuers.
Honestly, I think we're just taking the U.S. hurdle rate for an investment and making it globally accessible.
I mean, to me, it's about not having to use money. It's all going to become digital. Then how do you make transfer of money very easy and get a return as well?
Awesome. Well, thank you guys so much for being here. Well, we're going to go from right to left. Tell us where people can find out more about what you're doing, and then encourage people to, after these panels, make sure you catch up with these guys in person here while you're here. So tell us, Armand, where can people find what you're up to?
For sure. You can find us at ondo.finance. You can find us on Twitter at ondofinance. And coming up next is tokenized stocks for Ondo. So we're really excited to bring those to market.
Thank you. Nick?
Figuremarkets.com, where you can find all of our products. I don't know if some of you know, Figure is one of our original companies, which is one of the largest HELOC home equity loan generating companies. In the past 5 years, we've generated over $60 billion worth of home equity loans. And we just launched a nice product where you're able to actually directly invest in funding our home equity loans and generate about 9%. Thank you. Thank you, Zidane. 9%.
Yeah, noble.xyz, our stablecoin, we have a separate page called noble.xyz. I'm on Twitter, Jelena_noble. And yeah, happy to chat DeFi contracts.
Awesome. Thank you. And I'm Tyler. You can find me on X at Tyler Sherwin and chat with me after about BVNK and how we can help you. Let's give a round of applause for our panelists. Thank you guys so much.